Hi traders. Good trading morning. Gain not so big, but big enough for me to recoup yesterday's loss. I love it. Now it's time for me to hit the gym, but you know what? I want to have a serious talk with you about something. Something that I think might prove to be very valuable for your trading. All right? So, let's go. Coming in, the whole thing. It's work though. It's work. You know? But we gotta do it. We gotta do it. So. I'm not even done yet, but I do want to talk to you today about one of the biggest problems novice traders in particular experience and have during the beginning part of their trading development. And that is that they pay too much attention to the intraday P&L number that the platform shows you in the middle of your trade. This causes many traders to abandon their original plan. That is, if they have a plan. But let's talk about this a little bit more in detail. I just have to get back and finish my workout, but I'll be back. Traders, there's something called the neutral zone. And the neutral zone is what a lot of novices do not trade with. They do not trade with the concept of having a neutral zone. And I think it would be very beneficial if I explained in detail what this neutral zone is. In fact, I did that quite thoroughly this morning in my morning Periscope session. And I talked about the fact that there is a space between where you enter a stock and where the stop is. Where are you going to exit the trade should the trade not work, right? So listen, from your entry to your stop is neutral. But if the stock drops, assuming that you bought the stock, and it drops halfway to your stop, your platform's going to show a negative number. And that negative number often freaks novices out, but yet your stop hasn't been violated, which is your original trading plan, right? So are you really at a loss, even though your platform is saying at a loss? No, because you've determined your loss to be your stop, not before your stop. So the platform lies to you in a way, and this lie causes you to react. And whenever you react to a stock that is in the neutral zone, you're not trading. The market is trading you. Let me get back. We got a couple more to go. Listen, traders, in the same way that there is a neutral zone between your entry and your stop point, right? There's a neutral zone between where you enter and your intended price target or price area. Now, this means that you're actually not profitable until your planned profit zone or profit area has been achieved. So if you are halfway toward your intended profit-taking zone, your platform is going to say that you're profitable. But yet, that's neutral profitability. Your plan stated that you're not truly profitable until a specific price, area, or zone has been achieved, right? So you're really, truly not profitable, even though your platform's going to show you green, going to show you that you're profitable. And so it is this small profit on the way to the planned profit that, again, freaks novice traders out. And so they react to that green. They get fearful that that little bit of green in neutral territory is going to disappear, especially if they start to see it come back in a little bit. And as a result, they react again to whatever the market or their platform is saying. And again, whenever you react before your plan has been actually materialized, has been actually completed, whenever you're reacting in the middle of your plan, you're not trading. The market is trading you. Remember that. I've got 3 more exercises to go, but at the end, when I'm finished, I'm coming back to wrap this all up. I'm going to summarize it very nicely for you. All right? See you in a bit. Ciao. Okay, that's it for me. No more than 50 minutes, 45 minutes sometimes, tops 1 hour. Now, it's time for one of Barbara's great lunches. I'll see you there, right? Boom. Here I am. Beautiful lunch here. Take a look at that beautiful salmon. I'm gonna chow down on this with a nice glass of wine, and right after lunch, I'm gonna have a summary for you. Hi traders. Thank you for joining me on my workout journey. But at the same time, I hope that you have at least theoretically or conceptually understood the idea of neutral zones. Because as I've mentioned, if you do not understand that most of your actions should be outside of a specific price area, which I call the neutral zone, if you don't understand that, then you're likely to commit many of the common mistakes that novices and untrained traders make every single day of their lives. You see, you need to get the vast majority of your actions outside of this neutral zone. When you operate in the neutral zone, you increase the odds of playing the game of trading incorrectly. So what I'm going to do right now is, from a chart perspective, I'm going to demonstrate specifically what I mean by the neutral zone, and I'm going to show you some things that will help you ensure that the vast majority of your activity is outside of the neutral zone. So I'm going to use a stock called JD.com. It's the chart here in the upper left-hand corner of my platform, and I'm going to use that chart here today. I'm going to point out this solid red bar. Now, this solid red bar is a fairly violent negative red bar, but that negative red bar is in what I would call positive territory. It is above the key moving average. So below the key moving average, this is the key 200 period moving average, would be negative territory, generally speaking, and above would be positive territory. So we've got a violent negative bar in positive territory, which means that we have a certain degree of conflict. Now, most of your trades you want to take with zero conflict. So you're going to buy strong bars in positive territory, and you're going to short negative strong bars in negative territory. And if you keep the majority of your trades in sync with position, you're going to have a better chance at earning money consistently as a trader. Now, that's not the topic that I want to drill into today. I'm going to assume that some traders would want to go short into this bar because of its size, because of its power, because of its violence, despite the fact that it is in positive territory. So my traders might say, well, I do understand that this stock is in positive territory, so I have position against me, but the power of this bar is very, very, very strong. So I'm going to bet with the power of the bar. And some of them would go into this bar toward the end of the formation of this bar short, okay? Knowing that they're fighting position. So when they're fighting position, I tell them that's okay, but I don't want them to
fight position with heavy positions. So they would typically take this play. If they wanted to take this play, they would take it on the light side. But anyway, let's assume that they're betting on the downside by going short into this bar here. Their stop would be above the high of that bar. Now, my traders do utilize, in most cases, what I call a 2-bar stop. So this 1-bar violation of the stop is not enough to get them out of the trade. They need a second bar to actually go higher than the first bar that breaks. So this is not an official stop out, despite the fact that it looks like it did stop out or violate the high. It did not violate the high with a 2-bar stop. But anyway, so let's assume that the trader is short here, betting on a downward move, right, toward this 200 period moving average. Okay, so they get short. They have a mental stop 1 penny above the high of the first bar, their reason, and they get some downward movement. Okay, now let's say their rule for profit taking is 2-bar push. So let's say they get this 1-bar push. There's 1 bar right there. So 1 bar of profitability, but their trading plan demands that they only take profits on a 2-bar push. Okay, so this would be a second bar move in their desired direction. And so according to their trading plan, they don't have a profit on the 1-bar push, even though their platform is going to say that they're profitable. Their platform might say, depending upon the size of this, might say that they're up $150 on this 1-bar push or $200 on this 1-bar push, depending upon the size of their initial position. But just because the platform says that this trade is working and you have $200 at the current moment, the trader should not feel as though they're profitable, because until they get the second push, they don't have a takeable profit according to their trading plan. Now, if their trading plan said that they could take profits on 1 push, then they do have a takeable profit and they are no longer in neutral territory. But if the rule is 2 pushes, then I don't want my traders thinking that they have money. They do not have takeable money until they get 2 pushes, if that is their rule. And staying consistent with your trading plan, whatever rules make up your trading plan, is one of the keys to developing consistent profitability. You can't get consistent gains without applying your method, your template, your techniques consistently. You can't be all over the place, changing on this trade and then flip-flopping on another trade and expect consistent results to come from this wishy-washy, flipping back and forth, changing and tweaking every other trade. You're not going to gain consistency that way. So one of the ways to gain consistency is to create a set of rules that make up your overall trading plan, and to do it without fail over and over and over again. All right. So as this stock fails to give a second push, it fails on the second push. It gives 1 push. It fails to give a second push. As you can see, what happens is that 1 push gets erased by a move up. Now they're back to break even at this point. The platform is not showing any gains or losses at this particular point. As this stock moves up past the initial entry price, now the platform says that the trader is negative. So as the stock is moving up above the initial short point, the platform is demonstrating negative, 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 negative. But I don't want the trader to assume that they are negative. The platform might say that in this case, they're negative $180, $150, whatever the number is. But that's not a loss. That is neutral territory. So neutral territory in the context of this trade is anything below the stop out point and anything above the general area of where a two push move would occur. One push, two push. So this is your neutral zone. Do you understand? And so when a trader responds to the small gyrations of a stock inside of the neutral zone, they actually start to get played by the stock. That they fail to play the stock is actually playing them, swaying them with every gyration, every micro move, every little few ticks to the upside and a few ticks to the downside. They find themselves emotionally reacting to these small movements in the neutral zone. And the neutral zone should be left alone the vast majority of the time. There are exceptions, and I teach my traders what those exceptions are. But for the most part, 85% of the time, you should not be reacting to what a stock does in the neutral zone. And you should not be reacting to your P&L. All right. Your P&L in the neutral zone does go up and down penny by penny, but you can't be moved by the P&L. P&L traders are chronic losers. Plan traders move themselves to consistent profitability. All right. So if we follow this trade out, it ultimately over time did produce a little move to the downside. Nothing to write home about. And we can understand that because the play is a short in positive territory. And that's typically what you get when you fight position. But anyway, let's follow the play out. This trader shorts this bar toward the end of the formation of that bar. And let's say they short 200 shares. Okay. They have a mental stop above the high. They get a 1 bar push where their P&L says that they're profitable, but their rule says that they're supposed to take a profit on 2 bar pushes, and they don't get the 2 bar push. This 2 bar push ultimately disappears, moves up to the upside, and now as this stock moves past their original short entry price, the platform is saying that they're negative, 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 but they're negative in neutral territory. We blip one little blip above the high, but we need 2 bars above the high to actually get stopped out. So the trader's rule does not get them out because there is no 2 bar violation. All right, the stock falls back. Now their negative becomes less negative, less negative, less negative. All right, but they're not responding to that. This is all in the neutral zone. This original entry price is around this here. They're now break even. Their platform says that they have not a loss or a gain. They briefly go into positive territory, but that's not really positive territory. It's still in the neutral zone. Now the stock moves back to break even. Their platform says that they're not positive or negative. As we continue to move up, that platform says you are negative, you are negative, you are negative, but the trader is not going to respond to that. The trader knows that's a lie until they get officially stopped out. They're still in the neutral zone. We fall back to break even. Now the platform says that they're flat. We move back up marginally. Now the platform says that they're marginally negative, but the trader doesn't respond to these gyrations. The trader doesn't respond to these micro movements. The trader is not reactive to what the platform says in the neutral zone. And this is how calm, sure, powerful trading occurs. When a trader understands what moves are meaningful and what moves are not meaningful. You need to understand this concept of neutral zones so that you can be a calm, powerful trader. And you can differentiate between meaningful moves that need and require your action and the little fake moves that don't. And it's the fake moves that play the traders ridiculously over and over and over again, that trick traders over and over and over again, who who do not understand this. So as this stock moves back to break even at this particular point, the platform says that the trader's flat, not a win, not a loss. And now we move past the entry point. Now the platform is saying you're positive, a little less positive. Now you're more positive, you're more positive, you're more positive, a little bit less positive, a little bit less positive. Now you're more positive, boom. And the trader potentially decides, I'm going to take profits here. All right. And this is based on another item that I teach my traders, that once you break the low of your initial move, you have a right to take profits. Okay? Entry here, profit here. Small gain, took time, but we've already discussed that that's not surprising given the fact that it's a short in positive territory above the 200. So I hope this brief chart demonstration has cleared up the concept of neutral zones. And I'm telling you, traders, if you 80 to 85% of the time do not react to any of the moves that happen between your profit-taking general zone or area and your stop out point, if you just let the stock do its thing, if you just ignore what it does between those 2 points, between your stop out point and your profit-taking zone, if you just ignore whatever the stock is doing, whatever dance it's doing here, whatever it's trying to communicate to you, just ignore it. 80 to 85% of the time. There are exceptions, but that's not the topic today. If you can do this, you will diminish the number of times stocks trick you. You will diminish the number of times you experience false and frustrating stop outs. You'll be a calmer trader, a surer trader, a more powerful trader. My name is Oliver Velez, and once again, I'm coming to you with a powerful trading lesson that can potentially change your trading life forever. Until next time, traders, trade well. Boom!